Show, everyone. Not expecting a huge turnout for this one. Did not do a lot of advertising. I was just pissed off about the numbers we saw on the new home sales data today. So we're going to take some time. We're going to talk about it. We're going to go through the original headlines. Then we're going to talk a little bit about the written media versus what we saw on traditional television. And then we're going to get into the meat of the data. This is probably a little bit more data and chart intensive that we would otherwise see on a podcast. So I thought it'd be important to do this in this format where people could listen live or catch up on it later as a unique individual spin. So without further ado, let's go right into the super source here, where I'm going to share a little bit of the screen work over here, chart work as we like to call it in the biz, on some of the stuff we can expect to see. Let's start with the headline that kicked this whole thing off. I got this coming up on my feed on my phone while I was kind of doing some work today. And I had already planned to cover some of the new home sales data as part of this show tonight for this podcast, which will be released next Tuesday. So I want to say, let's see, let me check the calendar, make sure I know exactly when that's going to be. But effectively, that'll be 1 week from yesterday, so the 30th, right? So we knew that this was going to be important because of the data that was coming out. This week we had, just to give you some notable prints, we had the FOMC Mirren's speech. He's a new FOMC member appointed by Trump. We had servicing manufacturing PMI data on Tuesday. Fed Chair spoke. Powell spoke yesterday. And we always knew that today was the new home sales data. We always kind of expected some interesting things to happen, but today's numbers were kind of wonky. And for those of you who are curious, tomorrow, jobless claims, GDP for Q2 is coming out. You got durable good orders. You got existing home sales coming out. So today is just about new home sales, new builds, right? And this is the headline. New home sales soar 20% in August to a 3-year high. That sounds like, oh my God, the market's booming, yay! But that is not the story. Okay, that is a spin that I want to say lobbying groups and people who pay for media want you to believe. Hi, honey. Looking forward to seeing how the housing market goes. Me as well, my friend. Me as well. What's up, Saeed? So the headline here continues on. Sales of newly built homes rose a much larger than expected 20.5% in August compared with July, according to the U.S. Census. That's despite mortgage rates that are higher than they are today. So, sounds like it's moving against the market. Not necessarily true. The median price of a new home sold in August was $413,500, an increase of 1.9% year over year. Only if you buy into the rhetoric and you don't understand where this data is actually coming from. And we're going to get into that and explain why this is a complete misrepresentation. If you did read the article, and I'm going to read some, excerpts here, you're going to see that some of this was actually, kind of brought up in the article, but it wasn't ideal. So here we go. Sales of new built homes rose a much larger than expected 20.5% in August compared to July, with the highest sales since January of 2022, according to the U.S. Census. It was also the largest one-month gain since August 2022. Sales were 15.4% higher than August 2024, but they're not telling you why that gain happened. This count is based on people out shopping in August and signing deals when the average rate on a 30-year fixed mortgage was higher than it is today. The rate started August at 6.63%, according to Mortgage News Daily, and didn't really move much during the month. And we always expected the FOMC to cut rates. If you're listening to the show, you knew that we thought that rates were going to increase after the rate cut, not decrease like a lot of seasoned real estate professionals thought that they would. And that was very similar to what we saw with the last rate cut, where you saw, Fed FOMC cut rates, and then you saw an interest rate increase over the next month or so, about 1% in mortgage rates over time. So it was meaningful. Skipping on in this article, you did see little bits and pieces going out in here, but the home builders, National Association of Home Builders, not what I would call a reliable source of market information. Their solution to the affordability crisis is always lower mortgage rates. We were expecting a gain, but not that large, said Robert Dietz, chief economist at the National Association of Home Builders. Always important to remember the margin of error for new home sales is large. We'll need to wait for revisions next month and September data points to see if this smoothed out. So what he's basically saying is revision that happens in jobs Same situation here. They can and likely will be revised down. So just because you're seeing the home numbers headlines here doesn't necessarily mean that's what it's going to actually conclude at. And just like with the jobs numbers, you always hear the headlines like this, but you never actually hear about the revisions down unless they're wildly meaningful. Like, for example, the last jobs report, which was revised down over 900,000 jobs, over 1 million jobs between the last 2 revisions. And that did get some traction, particularly as it led into the FOMC meeting. It was a very big point, and somebody at the Bureau of Labor Statistics lost their jobs. But there was one quote here which I thought was interesting before I play the video, which I think is worthwhile to get into. So while a volatile figure each month and always best to smooth out, I have to believe that the elevated level of home builder incentives, and very important, was the main catalyst for larger upside surprise to new homes. So what this person is saying, and very astutely saying, is I have to believe that it wasn't the change in home prices, it wasn't the change in mortgage rates, it wasn't the change in the FOMC, it was that home builders are offering more incentives. They're offering to make the homes more financially attractive to buyers in a meaningful way, and that probably is what drove this. And that's actually the story that we're going to talk about and get into the data here. Wrote Peter Bookfar, Chief Investment Officer at One Point BFG Wealth Partner. That's a long name. And will, of course, see the impact of lower mortgage rates when the September figure comes out. I don't think you will. I don't think mortgage rates are going to go down. I think they're going to go up. So none of it there. But keep in mind, if mortgage rates continue down, builders will then reduce the pace with which they're implementing incentives and thus possibly offsetting the benefit of lower mortgage rates for new homes. So what builders are doing is trying to artificially keep up the home sales data to make the market look like it's hot by saying, hey, look at all the home sales. It's 20% year over year increase. This is meaningful. This is significant. Home sales are back, baby. They're hot. And this whole mortgage rate thing, don't pay attention to that because everybody needs and wants to buy a home right now. You should get in now because supply is going down. Well, those things are true. Supply is going down and the number of sales went up, not because mortgage rates changed meaningfully, but because the net effect, right, the home sale price minus the incentives actually brought home values down, but it's not reflected that way. So what you see, a 20% year over year increase in the number of sales and the perception of an increase in home price. The two things that started off the very beginning of this, where they said that's despite mortgage rates were higher than they are today. The median price of new homes sold in August was $413,500, an increase of 1.9% year over year. But that does not include the builder, quote, incentives against the price. So a bit of deception here. Let's watch some news before we get into some chart work. And I promise this stream will be a bit shorter than the last one, which was admittedly very, very long. Here we go.
New home sales just crossing. Diana Olick has those numbers for us. Diana.
David, a massive beat on new home sales. 800,000 seasonally adjusted annualized rate in August. The street was looking for 650. This is up 20.5% from July and up 15.4% from August of 2024. Now, we've been talking about mortgage rates, of course, forever, and they didn't come down in August. These numbers are based on signed contracts, so people out shopping in August when the 30-year fix had not started its steep drop that we saw in September. So it was well over 6.5% in the high 6% range. Now we're down at the 6.3% range. So this is a surprise. But again, we've been talking about the builders, their incentives. Lennar's earnings last week, they said they're doing price cuts. They're doing all kinds of mortgage rate buy downs and other incentives. Let's look at the price today. The price of a new home sold was $413,500. This is 4.7% above July, and it is above 1.9% above August 2024. So prices going up on this. It's really,
Are they really though?
Interesting that this is
Not
happening.
so
I
much.
guess people getting back into that
Not
market
so
before
much.
the fall season, which is usually kind of the second most busy as opposed
So pay
to spring
note,
season.
KB
but it is a real
Homes,
surprise
Lennar,
to see
and
prices
Toll
go
Brothers
up,
are
as
listed
well as
on this
sales
chart.
Go up.
We're going to
Inventories,
talk about
though,
that shortly,
we're
too.
looking at a 7.4-month supply. We had been at a 9-month supply in July. So inventories coming down, builders obviously making the push to get people in the door, but builder sentiment, again, wasn't so great in September. So these numbers are really quite something. Again, 800,000 up 20% month to month. Back to you.
Yeah, Diane, a lot of cross currents there. Thanks for breaking that down for us.
So
But first,
builder
new homes-
sentiment, not really high. Exactly. So what did the builders do? They knew that the market was going to show a pretty meaningful pivot in home price sales, and in new home sales. So what do? They decided that they would like to make those numbers look a lot better. But rather than bring down price, they decided to make the incentives significantly more attractive to home buyers to incentivize them into buying. So this came out, pissed me off to no end, and of course I had to do some digging. I went to Lance Lambert via X, Fannie Mae home price affordability. This is going to be meaningful here because I think this shows you that the home price is still meaningfully unaffordable. If U.S. income spiked 60%, we returned to pre-pandemic affordability levels, right? If U.S. home prices fell 38%, we'd return to pre-pandemic affordability. And if mortgage rates fell 4.15 percentage points, okay, that's a big drop from where we are today. From 6.5% down to 2.23%, we return to pre-pandemic affordability. That's how off we are from where we once were. Here's a chart in August. There were an estimated 35.2% more home sellers than buyers in the U.S. market. 35.2% more home sellers than buyers. A third, more than a third. And yet here you heard inventory of new homes went from a 9-month supply down to a little over 7 months. And I would point out that 6 months is considered healthy and normalized, so that isn't necessarily a bad change. So the idea that supply is shrinking and demand is going to go up because everybody's like, oh my God, it's supply and demand game. No, demand without affordability is not in fact demand, and this is indicative of that. So if you have 35% more sellers than buyers, right, but yet here is the home price change that you're seeing, something doesn't make sense just from a pure mathematical standpoint. With high percentages seen in prior months, makes for the strongest buyer's summer on record. And that's not per an association, that's per Redfin. This is a Redfin source data. They're in this business. They do not have a bias against realtors in the real estate industry. That's just them telling you what it is, okay? So there are more there are more sellers than buyers currently, and that is not what I would call something that should be driving up demand and seeing the numbers that we saw. So let's go back to Lennar for a little bit, okay? I think Lennar is important to talk about, but we're going to get into why there is such a huge part of this discussion shortly. This from Lennar's earnings, which were also reported this week. The gross margin of Lennar. They are a giant home builder, ranked number 129 in the Fortune 100 of all companies, just hit a 16-year low. That means their profitability, right? Their margin is basically what they're selling these homes for, their cost, and the difference, that's their margin. I mean, I'm paraphrasing a little bit. So if they're still selling homes, and we're selling homes at $413,000, a little over that $500, this huge number on the average for homes, yet their profit margins are at a 16-year low, that means they're adding to their expenses. And those expenses are the incentives they're offering. In order to maintain sales in this weaker housing market environment, Lennar spent an average of 14.3% of the final sales price on incentives in Q3 of 2025. So 14.3% of that final sales price was then given back to the end client. Now let's just do some rough math here. $413,500 times 0.143 equals $59,130. We're going to take the $413,500 and we're going to take that out, and the difference is an average price more closer to $354,000 on average, $369. That is the real sales price of the new homes that they were selling. So you can see there's a meaningful difference and disconnect in what the market is reading in the headlines versus what you're actually seeing here. So Lennar's sales incentives rate is at its highest level since 2009, just 2 years after the great financial crisis. And in my mind, the height of what was some of the REO issues in real estate owned. And they were competing against real estate bank-owned properties selling at a discount, right? Short selling properties with new properties. So this is a meaningful period of time in a comparison in their profitability. Lennar's gross margin is at its lowest level also since 2009, 7.8%, historically weak level. Lennar's average selling price net of incentives is down 22% from its 2022 peak. So you can look at all this and you can say what you want about this home sales being fantastic. That is not the real story. The real story is that home sales are only happening because the values are artificially kept up, but really kept down with incentives that offset the difference. And I'm sure someone out there is going to say, well, Chris, the home price is what it is. They're paying for it, and if they're getting added incentives, that they're still paying those dollars. Not really. No, you got to look at net cost to the actual consumer and net financial benefit. You can spin that however you want. That is just economic facts. But Lennar is showing you what has happened in the housing market to drive sales. You got to look at that and take that on face value. Lennar is showing you a little bit more than that, though. This from Reventure Consulting, Nick Gurley's firm, I believe. They've cut prices 22% as we just went through that exercise and are now below pre-pandemic pricing. Average sales price, like we just calculated, down here at $367,000 versus their new orders at $23,000. So if you look at the difference here, yeah, okay, you went from orders going from around 16,000, 18,000 to spiking way, way, way up these last 2 quarters. Well, that's not because there hasn't been a meaningful change. There has been, and that meaningful change is their average sale price has effectively gone down. Now, the average sale price of a home, in this case, is the home minus the incentives, which is their average sales price as represented on this chart. And this is not what the media is picking up, hence what I call the deception in the market. And I think it's inappropriate to suggest that the market is booming and it's amazing, but this is where people will buy into mainstream media and they'll think to themselves like, huh, this headline came out, it has to be true, and they won't read through and actually pick apart this stuff. And this is meaningful, and the housing pundits will argue that this is not true. I get it. Existing home sellers would be wise to take note of this, okay? You cannot deny that their margins have compressed in such a way that it's changed things. And if you're saying, Chris, that's just Lennar, why aren't you covering everybody else? You're a bad human. I would argue that I am a bad human, but not for those reasons. Here's the large public home builder quarterly market share based on new home sales. Wow. That's a lot of stuff you just said. I get it. Okay, this is going to compare the home builders. Almost a quarter, 25% of single-family housing starts nationally are tied to just 2 home builders. Just 2. Okay, D.R. Horton, that was on the chart when we first said, and I told you to take note, it was D.R. Horton, it was Toll Brothers, and it was Lennar. Well, D.R. Horton and Lennar account for 25% of all new home sales. Earnings last Friday, and when the Lennar announced its call, it's slowing starts, which also has implications for building product suppliers across housing. So a trickle-down effect, right? If they're slowing starts, as in new home constructions, to offset what they see as a potential weakness in the market, that means you got less contractors working, you got less supply being provided them in the form of lumber and raw materials. This is a trickle-down effect in the economy, and it certainly has impacts for GDP, certainly has impacts for existing sales. That data obviously due out tomorrow. So, I mean, again, meaningful stuff, and I think stuff that we cannot actually ignore, because if you look at this data and you ask yourself, okay, between these two in particular, D.R. Horton and Lennar have such a massive market share, and you say, okay, they're getting these massive incentives into the market to prop this up. Why are they doing it? They had negative sentiment going into this quarter because they were concerned where the market was going. So they tried to control the narrative of sentiment. They had 2 choices. They could either sell less properties, right, and have profits be compressed with a headline of "we sold less properties," or we could offer more incentives, sell more properties, and still have the same compression of profitability. But who really listens to earnings calls? We tell you all the time on this show, you got to listen to earnings calls, you got to get into the data, and you got to figure stuff out. And we always teach people to question the things you see in the media, because this is exactly why. You're going to get a spin here that is designed to prop up an industry. And there are a lot of people tied to this industry. There are all the economists and the real estate pundits. You have the Mortgage Bankers Association, the National Association of Home Builders. You've got everybody in the space that has a vested financial interest in this. And you have to ask yourself, anytime you see data, who is supplying it and why? It's no different in nutrition and health, and it certainly is no different in situations like this with real estate. So I will entertain some questions if anybody has some in the chat. Not a lot of people here. What's up, Misa? Logan, how are you? Hey, lots of wives in the chat. I'm happy to entertain some questions. Otherwise, that was all I was really going to do today. A quick 20, 30 minute or so show on this. We will cover this, Saeed and I, in the opening part of next week's podcast, which I hope you guys check out. We are also going to talk a whole lot about some really big news about some merger activity in the real estate space, which is going to affect our real estate professional listeners out there. I think the era of the overarching big firm is going to die, and these boutique real estate firms that I grew up with and call it the 80s and 90s are going to really prop up and continue to take over in the market in response to some of the things we're seeing. And Ryan Serhant actually really capitalized well on this, put up a website immediately, put up a hotline to, quote, consult people and try to walk them through their emotional concerns. It was brilliant marketing on his part, kind of something that he does best. So does this change high-priced areas like Newport Beach? Yes, it does. But in my experience, and this is a generalization here, what typically happens is the coast, when prices go up, start first, and then it goes into the Midwest, right? And then when prices start to go down, it starts in the Midwest and starts to kind of work its way outward. That is where I think you'll see that trend happening again. Newport Beach and Beverly Hills are always a bit unique in ecosystems, but I'm already starting to see some of it in high-end real estate. Without being too specific, I looked at two really, really high-end, I want to say 8-figure homes today. Got second appraisals on both of them because I was concerned the appraisals could be low. So I've got 2 appraisals on each property, which are literally 7 figures short of where they would have been just a couple of years ago. And that's because there aren't comps that have traded at that value in that market. Keep in mind, in Los Angeles, you also have the mansion tax and some of the things that have kicked in that have kind of limited the market a little bit. But certainly, I'm seeing it in some of the high-end properties as well. Where I think you're not going to see it as much is those properties between, call it $2 million to, I want to say, maybe about $5 or $6 million in Southern California or in high-end coastal communities across the country. I think those will be the last impacted. The super high-end properties and call it the middle class and starter home families. Again, this data is just from new home sales. Existing home sales tomorrow will also be very indicative, and it's less manipulated in my mind, but it also has revisions that have been meaningful over time. So what to watch out for the next 90 days. Certainly tomorrow's existing home sales, I think, is going to be important. I would watch the 10-year Treasury, see where that goes. I don't think mortgage rates are coming back down in a meaningful way unless something dynamic happens in the economy, and I really don't foresee that. So what I would say is you're going to see mortgage rates likely rise. That's going to further add fire to this. You're going to see a lot of the rhetoric that we saw leading into the last rate cut by a lot of the lobbying groups that you know, they make their money on the highest home price sales or the highest loan they can provide. They're going to argue the solution to the affordability crisis is lower mortgage rates. They're going to jump on board from a political perspective. It's going to look like they're backing the president and some of that narrative, but unfortunately they're really just backing their pocketbook, which also happens to be aligned with that. No bad, you know, judgment on them, because I really think you need a kind of a combination of all these things, lower home prices and lower rates to really get affordable again. I just don't know that lower rates is really viable. You also have some really interesting things going on in the stock market right now, which I don't think you can ignore as well. At any point in time, if the stock market were to take a hit, if the bond market were to take a hit, if the real estate market were to take a meaningful hit, and some of this data starts to turn negative, I think then you're going to start to see this trickle into the other markets that weren't initially affected. The question still remains, what is going to be the catalyst for what could be a recessionary economy if you think what we're in right now is not stagflation? But that remains to be seen. So with that, I got about 7 minutes left before I take off and take a little bit of a break before Saeed, Rajil, and I jump into tonight's recording. And I think I'm going to leave you guys here. Thanks for tuning in. If you like the lives, let me know. Shoot us an email, media@Higher Standard Podcast. This will be on the newsletter. If you haven't subscribed, it's in my link in bio on all the main social media platforms. And certainly happy to include more information on that. If you have any suggestions for it, email us as well. Thank you, everyone, and good night. Don't trust the media's take on this. It's wrong. Bye.